Welcome to the final session this evening of the regulatory environments for both the UK and the European financial markets. We've discussed the Digital Operational Act, DORA, in depth, and we'll briefly touch upon the UK Financial Conduct Authority and the UK's Prudential Regulations Authority's Operational Resilience Framework. What is the objective for the PRA, that is the Prudential Regulations Authority, and the Financial Conduct Authority? Their statutory objectives are different, but interrelated as well. For the PRA, their objective is to promote the safety and soundness of the firms that the PRA regulates. Secondly, to contribute to the securing of an appropriate degree of protection for insurance firms' policyholders. And the third objective of the PRA is to facilitate effective competition between financial services firms that it regulates. The FCA's objectives is to ensure, the overall objective is to ensure that the relevant markets function well. And its operational objectives are to secure an appropriate degree of protection for consumers, to protect and enhance the integrity of the UK financial system by ensuring that everybody that works in the sector acts with integrity, acts with the intention of protecting the consumer. The third objective is to promote effective competition in the interests of consumers. So the FCA is largely focused on the consumer and on the conduct of everyone that works within the financial services firms. What is the scope of both regulators' operational resilience rules? Relates to UK firms and financial market entities. So the scope is limited to the UK. Focuses on important business services. So the operational resilience rules places an emphasis on firms identifying their important business services provided to consumers that may impact upon the regulator's objectives that we've just viewed in the previous slide. The operational resilience rules require firms to set the impact tolerance level for each important business service, and we'll discuss that going forward. The rules also outline the expectation for outsourcing and third-party risk management, just like DORA. And the Financial Services Markets Bill gives statutory powers to the FCA, that is the Financial Conduct Authority, and the PRA, the Prudential Regulations Authority, to regulate critical third parties who provide services to the financial market entities and financial services firms. Just like DORA, the onus is upon these regulators to also regulate critical third parties in addition to the financial services firms. Let's take a look at a summary of the rules, the operational resilience rules from these two regulators. By the 31st of March 2022, firms were required to have identified their important business services, to have actually identified these, to have created an asset register, an information asset register, consisting of all identified important business services, offering services or supporting the services offered to their customers and clients and consumers. By the 31st of March 2022, firms or these regulated firms must have set impact tolerances for the maximum tolerable disruption in regards to consumers. Firms were also required to have carried out a mapping of those services and the facilities that support those services, including people, locations, systems, applications, infrastructure, that enable the provision of these important business services, and then to have tested to ensure that the firm would remain within the impact tolerances set. By the 31st of March 2022, firms were also required to have identified any vulnerabilities in their operational resilience. The second part of the regulations also mandated that as soon as possible after the 31st of March 2022 and by no later than 31st of March next year, that is 2025, firms must have performed mapping and testing so that they are able to remain within impact tolerances for each important business services. So whilst it was mandated that they should have started with the mapping and testing, the deadline for the completion of all of that work is the 31st of March 2025. And firms must also have made the necessary investments, including not only the financial investments, but with people and systems, invested in the right people to support operational resilience, invested in the right systems, infrastructure, applications, facilities, policies, processes to enable them to operate consistently within their impact tolerances. What is the scope of the PRA? The PRA's operational resilience rules. It applies to UK banks, UK building societies, PRA designated investment firms, CRR consolidation entities, UK Solvency II firms, the Society of Lloyds and its managing agents, that is insurers. That is the scope of the PRA's SS1 21 operational resilience rules. The FCA's operational resilience rules apply to UK banks, payments organizations, or e-money organizations, Building societies, recognized investment exchanges, PRA designated investment firms, that is banks, the enhanced scope of SM and CR firms, and then insurers. Timeline for both of these regulators' operational resilience rules. As I've said previously, from the 31st of March 2022, the came into effect. But work had started prior to this in March 2021. And by the 31st of March 2022, firms were required to have identified and mapped their important business services, set those impact tolerances, and started a program of scenario testing to test various scenarios, extreme and yet plausible or possible scenarios, were required to have commenced that program of scenario testing. After 31st March 2022, firms were then required to review their important business services at least once per year, or whenever there's a material change to their business. Let's say they acquire another firm or do a merger and acquisition with another firm, then firms would have been required to review their important business services because their customers, consumers, may have changed. So from the 31st of March 2022, firms were required to review their important business services at least once per year or whenever there's a material change to their business or the market in which they operate. To ensure that no emerging vulnerabilities have been overlooked or no emerging risks have been overlooked. By 31st of March 2025, operational resilience should essentially be business as usual. Firms should have tested to ensure that they are able to remain within their impact tolerance for each important business service in the event of a severe but plausible disruption or extreme disruption, including, for example, a cyber attack, an IT disaster, a pandemic, extreme but plausible scenarios. After Monday, the 31st of March, 2025, firms are expected to have implemented an effective and comprehensive operational resilience strategy. With regards to operational resilience, both regulators' objectives are to reduce the risk of harm to consumers in the event of an operational disruption, reduce the risk to market integrity, the viability of the firm itself, and stability in the entire financial system, in the entire market. These are the objectives of the operational resilience rules. Another objective is to outline the expectation for outsourcing and third-party risk management or third-party risk management of critical outsourcing providers, similar to DORA. The final objective is to strengthen operational resilience overall in the financial services sector, to reduce systemic risk, to reduce the risk of a large investment firm or a systemically important investment firm or bank affecting other financial services firms or the entire market in the event of a disruption. This is the scope of the operational resilience regulations now. UK banks, building societies, PRA designated investment firms, insurers, RIEs, SM&CR firms, and firms authorized and registered under the Payment Services Regulations 2017 or e-money regulations 2011. We've already mentioned this, that from 31st March 2022, firms have been required to identify their important business services and set those impact tolerances for the maximum tolerable disruption, and we'll talk about that in a moment, and conduct mapping and scenario testing to a level of sophistication necessary to do so. They must have also identified any vulnerabilities in their operational resilience and remediated these vulnerabilities. So it's not enough to have identified a list of vulnerabilities and simply put those in a register. Firms must have identified these vulnerabilities and then remediated those. So firms must have already started a program of work to remediate vulnerabilities that could impact upon their ability to stay within the impact tolerances that they have already set themselves. If there's a vulnerability that may stop you from remaining within that impact tolerance, then that needs to be remediated before the 31st of March 2025. And then by that date, firms must have tested each important business service to ensure that they could remain within their set impact tolerances. What is an operational resilience self-assessment? This is compiled by firms and approved by the SMT senior management team or board periodically, at least once a year. This self-assessment will include details of each important business service, the impact tolerances of these important business services, the mapping of these services, that is, who supports this important business service, which third party supports this, employees, third parties that support this particular important business service. Where are the servers located where this important business service has its data processed from? Where is the server actually located? Is it in the data center? Is it in the cloud? Location. So that's what the mapping consists of. And then the operational resilience self-assessment also consists of the testing strategy. How are we going to actually test this important business service each year? Any vulnerabilities identified from the previous year's testing and remediation efforts. That is what the operational resilience self-assessment is about. The self-assessment report will also document the methods used for identifying those important business services, including any new ones that have been identified since the previous year. During the self-assessment, a firm may also set updated impact tolerances. The contents include the executive summary, identified important business services, impact tolerances, mappings, scenario test plans, lessons learnt, vulnerabilities identified and remedial actions, and a communication strategy. So this self-assessment report is compiled by each firm. There's a mandate upon each firm to compile this self-assessment and have this approved by the SMT or board periodically and at least once per year. If, again, there are material changes in the firm's operations or important business services, then this operational resilience self-assessment needs to be conducted again. Impact tolerances, these are a time-based metric set by the financial services firms themselves. Time-based. The impact tolerance could be 1 day, 2 days, could be a week. And what is an impact tolerance? That is a maximum tolerable threshold where the harm caused to consumers or market integrity becomes intolerable. According to the FCA, a maximum tolerable threshold where the consumers cannot tolerate the harm caused by that business disruption is what should be used to set the firm's impact tolerances. Second, an impact tolerance should consider when there's a risk to the market integrity. There's a risk of harm to market integrity. When that becomes intolerable, that's when you should set your impact tolerance. So say, for example, your consumers or your customers, clients, would experience harm if your service were unavailable for 2 days. The service that you provide to them were to be unavailable for 2 days, then your impact tolerance should be set at 2 days, which means that you've got 2 days to fix whatever has caused that business disruption or that disruption to the service that you're providing to them. A maximum tolerable threshold where harm to consumers or market integrity becomes intolerable. From the Bank of England PRA side, an impact tolerance is a maximum tolerable threshold where financial stability, safety, and soundness of or policyholder, insurance policyholder protection is at risk. If we remember that the FCA's primary focus is upon the consumers and market integrity and conduct within the financial services sector. Whereas the PRA's primary focus is on financial stability, safety, soundness, and insurance policyholder protection, market stability, market safety, market soundness. So when setting our impact tolerances, these are the considerations that we need to make to determine how quickly we need to recover our important business services before they start, before that disruption starts impacting upon our consumers or upon our policyholders, if an insurance company, or upon the markets in general. How do we set and then test our impact tolerances? Every year, we identify our important business services at least once a year. And we map the facilities, the people, the systems, the information and processes that support the delivery of the service to the consumer. So if we work within a bank that delivers a mortgage product or service, mortgages to consumers, we need to identify the important business services, which is the mortgage product. And we need to separate the mortgage product into online delivery, where we may offer a mortgage service to customers or consumers online. We may also offer a mortgage advisory services to customers who come into our bank face to face. We may also offer the same service through third parties or brokers. Those will be considered as 3 separate important business services. And we'd then be required to map the facilities, the locations where these products or these services are delivered from. We'd need to identify and map the people, the systems, the information and processes that support the delivery of that mortgage service to the consumer. Then we establish metrics regarding the day-to-day business as usual running of each important business service. How frequently do we offer this service? Each of these important business services, how frequently do we offer these? What is the duration of the time that we spend with each consumer or customer when offering that service? Then we now test the firm's ability to deliver services within those impact tolerances. Let's say we've said that, okay, that the maximum time, the maximum tolerance, the maximum impact tolerance is a day. If our mortgage service is unavailable for beyond 24 hours, this would start causing intolerable harm to our consumers. We then need to test the firm's ability to deliver services, those mortgage services, within a day in the event we were to experience a severe disruption. For example, a cyber attack. We need to test that in the event of a cyber attack, how could we continue to deliver these mortgage services within a day, or recover within less than a day to enable us to continue to deliver our services to the consumer? So we identify those important business services, establish metrics, we stress test the firm's ability to deliver services within those impact tolerances. We assess how a disruption could impact our consumers. We set those impact tolerances signed off by our senior management team and board and continually monitor these. So we continue to test these each year at least. And this must be signed off by SMT/the board and then continually monitored. And if there is a business disruption, that may be the time after lessons have been learned, after the lessons learned report has been drawn up, to again identify any important business services that may have been missed the first time before the disruption. So this is not a static document. This register of important business services, it is not static. And it should be reviewed and updated periodically. In some cases, if a business disinvests in a particular service, let's say a bank decides to stop offering mortgages, then that important business service needs to be removed from the register. Again, I've just spoken to all of these. Firms are required to identify the important business services of which, if disrupted, could potentially cause intolerable harm to the firm's consumers or pose a risk to the soundness, stability, or resilience of the UK financial system or the orderly operation of financial markets. At least once a year, or whenever there's a material change to their business or the market in which they operate. Each important business service, as I've said, should be clearly classified as a separate service and not a collection of services. So online banking, withdrawing cash at an ATM, and withdrawing cash at the counter should be identified as 3 separate services. And the impact of a severe but plausible disruption should be tested each year. We should be testing the impact to our customers in the event the online banking system were to be disrupted. Separately, tests should be conducted for the impact to our consumers in the event all ATMs were to go down, the ATM network, cash point network were to go down. Again, separately, we need to do our tests for the eventuality that withdrawing cash at the counter, if that were to be disrupted, what would the impacts be upon our consumers as a bank? Now, a note here, important business services are services which serve a firm's consumers directly. So whilst some may argue that, well, our payroll system is an important business service, because this system is used to ensure that employees are paid. According to the regulations, the focus is not on internal systems. The focus is on systems that support the provision of these important business services to the consumers. This doesn't mean that people employees, contractors, third parties, processes and systems that underpin the important business services shouldn't be mapped and tested. For example, you may want to draw up a key persons register of critical people in the firm that support or maintain these important business services, so that in the event of a disruption to these services, you have a means of promptly contacting that network of employees, contractors, consultants, third parties to assist in the prompt recovery efforts. What is intolerable harm? How do we assess intolerable harm to our consumers? Some criteria could be the number and types of vulnerability of consumers that may be adversely affected in the event of a business disruption. For example, let's say you've got a small or micro building society that offers products to pensioners solely. To pensioners, they may be classed as vulnerable consumers, of which, in the event their pensions or the pension system, the payment system, the pensions payment systems were to go down, these consumers may be at risk of intolerable harm, because if they can't withdraw their weekly pension or their monthly pension due to a disruption of that bank, that could cause harm to them. So when considering intolerable harm, we take a look, we consider the number and type of consumers that may be adversely affected in the event of a severe but plausible disruption. The extent of loss to consumers is another consideration for intolerable harm. If we're a banking or a bank, an actual bank, a retail bank, for example, if a severe disruption could cause our consumers to lose their entire pension or their entire savings, whereas the Financial Services Compensation Scheme only offers compensation up to a limited amount. If the consumers were to be at risk of losing over the FSCS, the Financial Services Compensation Scheme's cap, compensation cap, then that would be intolerable harm to the consumers or the clients of that bank. Another criteria is financial loss to the firm, where this could harm all the firm's consumers. Financial loss to the firm, where this could harm the soundness, stability, or resilience of the UK financial system, or the orderly operation of the financial markets. Intolerable harm, which has a high impact to market or consumer confidence. The spread of risks, so contagion, to other important business services, firms, or the UK financial system. This could be deemed as intolerable harm. Loss of functionality or access for consumers, any loss of confidentiality, integrity, or availability of data. Intolerable harm means harm from which consumers cannot easily recover. The regulator has specified that firms should not seek to resume an important business service if the harm caused to the consumer from resuming would be greater than the breach of an impact tolerance. So we've seen an instance a few years ago now where TSB, I believe it was, experienced a disruption which was severe. Having tried to fix the disruption, fix the course of disruption, systems were then brought up. And unfortunately, when the systems were now brought up, this then resulted in fraud to a lot of TSB customers. Some of them were contacted by fraudsters and told to provide a code or something which gave those fraudsters access to their accounts. And TSB was fined very heavily for that recently, for that incident. And so what the regulator is saying and stressing here is that firms should not seek to resume an important business service if the harm caused to the consumer or customer from resuming would be greater than breaching an impact tolerance. So if you were to say that your impact tolerance of offering online banking to your customers is 1 day, 24 hours before intolerable harm could be suffered by them. If in the event of that disruption, there's a risk of fraud to your customers, you don't then restore or resume that important business service, that online banking service, just to meet or to stay within your impact business tolerance. You have to mitigate the risk of fraud to your consumers and mitigate the risk of further harm to your customers before resuming that important business service. It's better to breach an impact tolerance than to resume within that impact tolerance and cause further harm to the customer. When a firm is using a third-party provider in the provision of important business services, it must work effectively with that provider, with that third party, to set and remain within impact tolerances. I used to work for a firm, for a bank, whereby I made sure that I had yearly, at least annual meetings with critical service providers, third-party providers, just to ensure that they understood our strategic objectives and that we understood what they could offer us in the event of an interruption. So it just used to be a workshop, just meeting with all these critical third parties in one room. So when a firm is using a third-party provider, it must work with that provider to set and remain within impact tolerances in the event of a business disruption. And whether a firm uses third parties or not, external third parties or contractors, the requirements to set and remain within impact tolerances still remain the responsibility of the firm, senior management / the board, essentially. Senior management and the board will remain accountable for impact tolerances, the setting and operational resilience, the setting of impact tolerances and the overall operational resilience program. Outsourcing and third-party management. Firms who use outsourcing providers must take reasonable care to organize and control their affairs responsibly and effectively with adequate risk management in place. Intra-group outsourcing is when a firm enters an outsourcing arrangement with a company in the same group, including cross-border outsourcing to parent or sibling companies outside the UK. So I've again worked in a bank whereby there was a massive firm outside of the UK with the same name as ours, where we outsourced all of our IT to. And in that instance, according to the regulators, those or the arrangement in place between both entities, even though they're the same name, the arrangement needs to meet the same requirements as if the firm were to be outsourcing to an external third party. So let's give an example of Amazon, the e-commerce company, and Amazon Web Services, the infrastructure company. According to the regulators, the Amazon Web Services company is to be viewed by the Amazon e-commerce company in the same light as if the e-commerce company were to be outsourcing its IT provision to Microsoft Azure, for example, or to the Google Cloud. So with intra-group outsourcing arrangements, the same obligation is placed on the board, senior management, to ensure that all of these rules, operational resilience rules, outsourcing rules, third-party management, that these are followed and adhered to. And that company, that intra-group arrangement is viewed as if it were an arrangement with an external third party. Firms are expected to manage the amount of data being stored, processed, or transmitted by third-party providers on behalf of the firm to reduce information security and compliance incidents. So, of course, data privacy impact assessments. To ensure that we have oversight, we retain oversight of any data being transmitted by third parties on behalf of our firm. Information security assessments before signing a contract with that third party. The board or delegated senior management executives must sign off the mapping exercise. And firms are to map and identify the people, processes, technology, facilities, and information that support the operation of their important business services, and make sure we consider key person risk. What happens if a key person that has spent years building that system, supporting that system, is suddenly unavailable? So ensure knowledge sharing, documentation. So when doing that mapping, actually, brilliant idea to map any documentation, systems documentation to each technology. that supports an important business service. Ensure that you've got a knowledge management database as well, where your key staff, key persons dump information into that knowledge management system. So that knowledge is not just retained within one or two key people. When must firms test their impact tolerances? Cyber attacks, power cuts, pandemics, natural disasters on a regular basis. When there is a material change to the firm's business, the important business services identified or impact tolerance is set. Or if we've made improvements in response to a previous test, or if we've had audit recommendations, then we may want to test our impact tolerances. Again, proportionality is important here. When we're selecting our testing method, we need to consider the size, scale, and complexity of our firms. Again, what sector do we operate in? What products do we offer? What services do we offer? So both regulators propose proportionality. And if you're unsure of the applicability of these regulations to your firm, approach the FCA, the PRA, or as I said earlier during this workshop, your competent authorities if DORA applies to you. Approach them for guidance. Don't simply take a manual and say, I know all about DORA. I know all about the UK's FCA and PRA's operational resilience rules, and I need to apply this all today before the deadlines of 17th of January 2025 for DORA or the 31st of March 2025. Conclusion. A firm cannot be financially resilient if it is not operationally resilient. And global financial services regulators have adopted digital and third-party operational resilience as priorities in recent years in a bid to protect industry consumers and customers from harm. So if a firm, prior to all these digital operational resilience mandates, the focus was largely on financial resilience due to the last global economic crisis. But now that the risk of a financial crisis is being managed through different directives, including the Capital Requirements Directive, whereby firms are required to set aside a certain amount of capital in reserves to deal with the eventuality of many crises that could impact upon the financial viability of the firm. The attention has now turned to digital and third-party operational resilience, with the focus remaining to protect customers and consumers from harm. And this is indeed a positive step forward for consumers. Thank you so much for attending our workshop today, and we wish you great success in all your endeavors. Whether you work as a BA, project manager, information security professional, a consultant, operational resilience professional, risk professional, penetration tester, whatever you do, make sure you just do it well. Don't forget to follow the Ladder Back Down on LinkedIn for updates on future workshops, or on our YouTube channel, or in addition to our YouTube channel. And you're welcome to connect with me as an individual on LinkedIn. If I can help, I will. Thank you so much for your time today. And good luck with your implementation of these regulations and ongoing maintenance and management of these regulations.